In the fast-evolving world of investing, the landscape is more complex than ever before. Information moves at lightning speed, markets react to global events in real time, and social media amplifies every headline and rumor. Amid this whirlwind, investors, whether seasoned professionals or first-timers, face a host of challenges that can make or break their financial futures. But among all the potential missteps, one mistake stands out as the most pervasive and consequential: making emotionally driven decisions in response to short-term market fluctuations. It's a temptation that's hard to resist. With every market downturn, the instinct is to protect your hard-earned money by selling off assets before things get worse. When markets surge, the fear of missing out pushes many to chase after the latest trending investments, hoping to ride the wave of quick gains. Yet time and again, history shows that these emotional reactions rarely pay off in the long run. In fact, they are often the very behaviors that erode long-term returns and undermine even the best-laid investment plans. Recent years have provided countless examples. As financial headlines blare warnings of volatility, and social feeds fill with viral stories of overnight riches or sudden collapses, many investors have found themselves swept up in the emotional roller coaster. According to a 2025 analysis by Forbes, this tendency to invest based on the latest news is a classic and costly error. The article highlights how impulsive decisions, buying into hype or fleeing in panic, almost always lead to disappointing outcomes. One of the main reasons this mistake is so damaging is that it causes investors to break from their carefully considered strategies. Investment plans are typically designed with long-term goals and risk tolerances in mind. But when fear or excitement takes over, discipline goes out the window. Instead of sticking to a steady course, investors react to short-term noise, selling during downturns and buying during rallies. This not only locks in losses, but can also mean missing out on the recoveries and growth that often follow periods of volatility. The challenge is compounded by the sheer volume and velocity of information available today. News stories, economic data releases, geopolitical events, each has the potential to move markets, and investors can feel compelled to act on every new development. Yet, as financial professionals consistently point out, attempting to outsmart the market by predicting short-term movements is a losing game. Even seasoned experts struggle to do this consistently, and studies have shown that most attempts at market timing result in missed opportunities rather than outsized gains. A recent survey of fund managers by Bank of America underscores another crucial point: the dangers of overexposure to trending sectors or regions. As of 2025, a net 37% of fund managers reported being overweight in emerging market stocks, the highest level since early 2023. This surge reflects optimism about growth prospects in these markets, but it also highlights the risk of herd mentality. When too many investors pile into the same assets without thorough research, the potential for disappointment grows. The lesson is clear. Following the crowd, especially when driven by emotion or momentum, can amplify risks rather than mitigate them. In light of these realities, what can investors do to avoid the biggest mistake of our time? The answer lies in developing and sticking to a disciplined, evidence-based investment strategy. This begins with clear goals and an honest assessment of risk tolerance. Rather than reacting to every market hiccup, successful investors focus on the big picture, maintaining their course through ups and downs. One proven approach is dollar-cost averaging, the practice of investing a fixed amount at regular intervals, regardless of market conditions. This strategy takes emotion out of the equation, ensuring that investors buy more shares when prices are low and fewer when prices are high. Over time, this can smooth out the effects of volatility and help build wealth steadily. Equally important is diversification. Concentrating too much of a portfolio in a single asset class, industry, or geographic region can expose investors to unnecessary risks. The events of the past few years have made this painfully clear. While certain sectors or markets may experience periods of rapid growth, downturns can be just as swift and severe. By spreading investments across a range of assets, including stocks, bonds, real estate, and international markets, investors can help balance potential losses and gains, making their portfolios more resilient in the face of uncertainty. Yet, diversification is not a one-time task. As markets evolve, so too must investment strategies. Regularly reviewing and rebalancing a portfolio ensures that no single position grows too large and that investments remain aligned with long-term goals. It's a process that requires diligence and self-control, qualities that are often in short supply during turbulent times. Another critical factor is the importance of thorough research. The allure of emerging markets or trending industries can be strong, especially when stories of outsized returns dominate the headlines. But as the Bank of America survey shows, following the herd without careful analysis can be risky. Each investment should be evaluated on its own merits, considering fundamental factors like growth prospects, valuations, and potential risks. Blindly chasing performance is a recipe for disappointment. Financial advisors and experts echo this sentiment. They recommend that investors resist the urge to act on every news story or market move. Instead, they suggest focusing on long-term fundamentals, maintaining a diversified portfolio, and revisiting investment plans periodically to ensure they remain appropriate. For those who struggle with emotional decision-making, working with a trusted advisor can provide invaluable perspective and discipline. The psychological aspect of investing cannot be overstated. Emotions are a natural part of the human experience, and it's easy to be swayed by fear, greed, or excitement. But successful investors learn to recognize these impulses and to make decisions based on reason rather than emotion. This might mean sitting tight during a market sell-off or resisting the temptation to pour money into the latest hot stock. It also means accepting that short-term losses are an inevitable part of the investment journey and that patience is often rewarded over time. The events of the past decade offer powerful lessons. From sudden market crashes to unexpected rallies, those who stuck to their strategies, keeping emotions in check, have generally fared better than those who tried to time every move. The data is clear. Over long periods, markets have tended to recover from downturns and deliver positive returns. But those who panic, sell during lows, or chase trends at the top risk missing out on this growth. In the end, the biggest mistake investors make today is failing to control their emotions in the face of constant, often overwhelming information. The antidote is a disciplined approach, grounded in research, diversification, and a clear-eyed focus on long-term goals. By resisting the urge to react to every headline and by sticking to a well-thought-out plan, investors put themselves in the best position to achieve lasting financial success. But knowledge alone is not enough. The real challenge lies in putting these principles into practice, especially when markets are volatile and emotions are running high. This is where preparation and self-awareness come into play. Before making any investment decision, it's wise to pause and reflect. Am I acting on impulse or in line with my strategy? Is this choice based on sound research or on fear or excitement? By asking these questions, investors can avoid the pitfalls that have ensnared so many others. Of course, no strategy is foolproof. Markets are unpredictable, and every investment carries some degree of risk. But by focusing on what can be controlled, discipline, research, diversification, and patience, investors can greatly improve their odds of success. And by learning from the mistakes of the past, they can build a foundation for a more secure financial future. As we look ahead, the importance of these lessons will only grow. The pace of change in the world of investing shows no signs of slowing, and new challenges and opportunities will continue to emerge. But the core principles remain the same. Avoiding emotional decisions, maintaining a diversified portfolio, conducting thorough research, and keeping long-term goals in mind, these are the keys to navigating the complexities of today's investment landscape. In summary, the biggest mistake investors make today is allowing emotions and short-term thinking to dictate their actions. By recognizing this trap and committing to a disciplined, well-informed approach, investors can sidestep the pitfalls that so often derail financial plans. In doing so, they not only protect their wealth, but also position themselves to benefit from the opportunities that the future will undoubtedly bring.